The rate of growth of M2, a broad measure of the money supply, has slowed dramatically in recent months. This slowdown is a significant cause for concern. It suggests that the Federal Reserve's aggressive interest rate hikes may be working to slow the economy. A shrinking money supply can have a number of negative consequences. It can lead to reduced investment. It can also make it more difficult for businesses to obtain the financing they need to operate. Some economists argue that the slowdown in M2 growth is a sign that the Fed is too focused on fighting inflation. They argue that the Fed needs to be more concerned with supporting economic growth. They warn that the Fed's current policies could tip the economy into a recession. The Fed is facing a difficult balancing act. The central bank needs to bring inflation under control without causing a recession. The slowdown in M2 growth suggests that the Fed may be walking a tightrope. The current economic situation is often compared to the early 1980s. This comparison is frequently drawn by analysts and commentators who see parallels in the challenges faced by the Federal Reserve then and now. At that time, Paul Volcker's Federal Reserve raised interest rates sharply to combat high inflation. The inflation rate had soared to double digits, and drastic measures were deemed necessary to bring it under control. The Volcker shock, as it became known, did succeed in taming inflation. The aggressive interest rate hikes eventually brought inflation down, restoring some stability to the economy. However, it also triggered a deep recession. The high interest rates led to a significant economic downturn, with many businesses closing and unemployment rates soaring. There are some superficial similarities between the current situation and the early 1980s. Inflation is elevated, and the Federal Reserve is once again raising interest rates in response. The Fed, under Jerome Powell, is taking steps to address the rising inflation by increasing interest rates, much like Volcker did decades ago. However, there are also important differences. The economic landscape today is vastly different from that of the early 1980s. In the early 1980s, inflation was driven by strong consumer demand and rising wages. The economy was overheating, and the demand for goods and services was outstripping supply. Today, inflation is largely the result of supply chain disruptions and geopolitical uncertainty. The COVID-19 pandemic and international conflicts have created bottlenecks and shortages, driving prices up. The Volcker analogy is misleading. It oversimplifies the complexities of the current economic situation and risks leading policymakers astray. It risks obscuring the unique challenges facing the current Fed. Today's Federal Reserve must navigate a different set of economic variables and uncertainties. Unlike in the early 1980s, today's inflation is not primarily the result of excessive demand. Instead, it is driven by factors such as disrupted supply chains and geopolitical tensions. The current inflationary pressures are largely the result of factors that are beyond the control of the Federal Reserve. Supply chain issues and geopolitical events are not easily managed through monetary policy alone. The Fed must be careful not to repeat the mistakes of the past. Overly aggressive interest rate hikes could lead to unintended economic consequences. Raising interest rates too aggressively risks pushing the economy into a recession. The balance between controlling inflation and maintaining economic growth is delicate. The central bank needs to strike a delicate balance between fighting inflation and supporting economic growth. This requires a nuanced approach, taking into account the unique challenges of today's economic environment. The United Kingdom's recent experience provides a cautionary tale about the risks of sharp interest rate increases. The rapid adjustments in monetary policy can have far-reaching and often unintended consequences that ripple through the financial system. In late 2022, the Bank of England was forced to intervene in the bond market to prevent a collapse of the pension system. This intervention was a dramatic move, highlighting the severity of the situation and the potential for widespread financial instability. The near meltdown was triggered by a sharp rise in UK government bond yields. These yields spiked unexpectedly, causing panic among investors and leading to significant market turbulence. The rise in yields was in turn caused by the Bank of England's aggressive interest rate hikes. These hikes were part of a broader strategy to control inflation, but they had the unintended effect of destabilizing the bond market. The central bank was attempting to combat inflation. However, its actions backfired. Instead of stabilizing the economy, the sharp rate hikes led to increased volatility and uncertainty. The sharp rise in interest rates led to a sell-off in the bond market. Investors, fearing further rate hikes and economic instability, began to offload their bonds, exacerbating the market decline. This sell-off threatened to destabilize the entire financial system. The interconnected nature of global finance means that turmoil in one market can quickly spread to others, creating a cascade of financial distress. The Bank of England's intervention prevented a full-blown financial crisis. By stepping in to stabilize the bond market, the central bank averted a potential disaster that could have had severe repercussions for the broader economy. However, the episode served as a stark reminder of the dangers of sharp interest rate increases. It underscored the need for central banks to carefully consider the timing and magnitude of their policy moves. When interest rates rise quickly, it can put significant stress on financial institutions. Banks and other financial entities may struggle to adapt to the new rate environment, leading to potential liquidity issues and financial strain. This stress can lead to a cascade of failures. As one institution falters, it can create a domino effect, impacting others and amplifying the overall financial instability. The UK's experience is a warning to central bankers around the world. It highlights the importance of a measured approach to monetary policy, especially in times of economic uncertainty. The Federal Reserve must proceed cautiously as it raises interest rates. A balanced approach is crucial to avoid triggering similar market disruptions and financial instability. The central bank needs to be mindful of the risks of destabilizing the financial system. By carefully calibrating their policy actions, central banks can help ensure economic stability and prevent unintended consequences. The Federal Reserve is not the only central bank grappling with the challenges of inflation and slowing growth. Central banks around the world are facing similar dilemmas. In recent months, both China and Japan have intervened in currency markets to support their respective currencies. The Chinese yuan and the Japanese yen have both weakened sharply against the US dollar in recent months. This weakening is partly due to the Federal Reserve's interest rate hikes. As the Fed raises rates, it makes US dollar-denominated assets more attractive to investors. This can lead to a flow of capital out of other currencies and into the US dollar. To counteract this trend, both China and Japan have intervened in currency markets. They have sold US dollar reserves and bought their respective currencies. These interventions are a sign of the growing concern about the strength of the US dollar. The interventions by China and Japan are a reminder that the Federal Reserve's actions have global implications. When the Fed raises interest rates, it can have a significant impact on other economies. The Fed must be mindful of these spillovers as it charts its policy course. So, as we move forward, it's important to recognize the signs of deflation that are starting to appear. Deflation, unlike inflation, is characterized by a general decline in prices for goods and services. While this might sound beneficial to consumers at first glance, it can have serious negative consequences for the economy. You see, when prices begin to fall consistently, it can create a cycle that's tough to break. Lower prices can lead to reduced revenues for businesses, which in turn may result in cost-cutting measures such as layoffs or reduced investment in growth. People might start delaying purchases, expecting even lower prices in the future, and this can slow down economic activity even further. This behavior, known as the deflationary spiral, can be particularly damaging as it reduces overall demand in the economy. Now, one of the key indicators to watch is the Consumer Price Index, or CPI. The CPI measures the average change over time in the prices paid by consumers for a market basket of goods and services. If the CPI shows a downward trend over a period of time, it could be a clear signal of deflation. This trend can indicate that the purchasing power of money is increasing, but it also suggests that demand is weakening. Another thing to keep an eye on is the behavior of businesses. Companies may start to lower their prices in an attempt to attract more customers, but this can also be a sign that they are struggling to maintain their sales volumes. If companies start cutting prices to attract customers, it might indicate they're struggling to maintain sales volumes. This can lead to a reduction in profit margins, making it harder for businesses to sustain their operations. This could lead to lower profits and, eventually, job cuts. When businesses are forced to lay off employees, it can further reduce consumer spending, exacerbating the deflationary cycle. In addition, central banks often respond to deflationary pressures by adjusting interest rates. Lowering interest rates is a common strategy to encourage borrowing and spending, which can help stimulate economic activity. They might lower rates to encourage borrowing and spending, aiming to boost economic activity. However, this approach has its limitations, especially if interest rates are already near zero. However, if rates are already low, their ability to combat deflation becomes limited. In such scenarios, central banks may need to explore unconventional monetary policies, such as quantitative easing, to inject liquidity into the economy. So, it's crucial to understand these signals and prepare for potential impacts on the economy. By staying informed, businesses and individuals can take proactive steps to mitigate the risks associated with deflation. This awareness can help policymakers, businesses, and individuals make more informed decisions in these challenging times. Understanding the complexities of deflation can lead to better strategies for economic stability and growth. As the economic slowdown deepens, trust in the central bank's ability to manage the crisis begins to waver. People question whether traditional monetary tools are enough to stabilize the economy. The uncertainty grows, and with it, a crisis of confidence in monetary policy itself. The downturn in the housing market triggers a chain reaction. As home values plummet, consumer spending contracts. The auto industry, heavily reliant on consumer financing, starts to feel the pinch. Sales drop, and layoffs follow. The ripple effects spread through the economy, affecting multiple sectors. Just when it seems the situation couldn't get worse, a new threat emerges. Global trade tensions start to escalate, adding another layer of complexity to an already fragile economy. Tariffs and trade barriers disrupt supply chains, leading to increased costs and further economic strain. The Federal Reserve finds itself in a tight spot. With interest rates already near historic lows, there is limited room to cut further. Unconventional measures, like quantitative easing, are considered, but their long-term effectiveness remains uncertain. The Fed must navigate these uncharted waters with caution.